Hey Val investors, thank you for joining me. Today I want to talk about portfolio strategy, high probability investing. Before we get started, I want to remind you can do a trial on a marketplace. It's called Deep Value Returns. I'll tell you which stocks I own and why, with balanced arguments for the stocks I own. What I talk about in my video I apply in my marketplace, and you can find it helpful. Check out the reviews. You can just Google Deep Value Returns and you can see the reviews that other people have from the platform. Also, don't forget to subscribe so you can get my next value installment. So with that aside, let's get started. So I want to talk about 3 different areas that help you think about your portfolio strategy. So number 1 is talking about a benchmark for success, a realistic benchmark for success. Number 2, I want to talk about knowing the market versus knowing the future. And number 3, the power of dollar cost averaging. So let's get started. So when it comes to having the right benchmark, I believe you're much better off understanding the following rule. The best analyst in the world is only going to be right 2 out of 3 times. That's the John Templeton quote. And in this sense, it means everyone's going to mess up, whether you're Warren Buffett, Charlie Munger, Joe Greenblatt, Walter Schloss, Monish Fabrai, whoever, Bill Ackman. You're going to have some failures. So have that mindset when you size your portfolio. So you should be thinking about a 40% failure rate, okay? I tell that everyone in my marketplace. That's the mindset. Not many professions that you can fail 40% of the time and still come out to success. But that's how you have to frame it. Whenever you get passionate about an investment, whenever you think this could be the one, think there's a 40% failure rate. But what's even more insightful than that is that you don't actually need to be right 60% of the time. You just need to be right slightly more than 50%. That's great, right? It's not that difficult. And even better than that, it's not so much being right or wrong, it's just about how much you make when you're right and how much you lose when you're wrong. And that's a George Soros quote. So having that in your mindset, I believe, creates the framework for your portfolio. I think that's quite helpful for your portfolio. So now I want to talk about number 2, knowing the market versus knowing the future. Okay? Ultimately, nobody knows the future. And when it comes to investing, there's a lot of highfalutin analysts and they kind of come out with all kind of the buzzwords, and just put all of that aside because ultimately nobody has a clue. So start with your mindset of I don't know. I always go back to that. I don't know. I think this may work out in the following way. Just putting the probability to your side. That's what I'm talking about in my marketplace. Get people that it's about high probability. You're just aligning by being very selective, not investing in every single stock that could work out. Just narrow it down. Being very selective and knowing the market. So I believe that it's important to have a correct work ethic when it comes to investing. So you have to combine 2 very distinct attributes. You have to be very, very patient when it comes to investing. You have to think like a business owner. And strangely, you got to work like a fanatic. So it's these 2 very kind of diametric type of characteristics, you have to nurture, you have to really build them through. You have to go with the mindset, Monday morning, this has to happen. I got to put a certain amount of work. It can be 15 minutes, it can be half an hour, it can be an hour. But every single day, you got to chip away and build a database in your mind of different sectors. So I'll give you an example. Many people right now are very passionate about the theme of work from home. So they're positioning their portfolios along the theme of work from home. Anything that can be helping or facilitating the customer's journey towards digitalization is getting really high premium. And this is something that I've been talking about from my videos, is that when Q2 earning results come around, you will see that there's a lot of high expectations, but the results are really not looking that good. And you see that right now in the cloud stocks. So coming into Q2, you can see that when many of these companies reported, the whole sentiment is kind of like depressed slightly. So we're right now in August, so it's just like middle of the reporting for a lot of these cloud stocks. But you can see that even though they had a very stellar Q2 result, it's looking already that the effect of the main street, the actual underlying economy, is not so strong. So the outlook is really, for many of these cloud stocks, coming down. And I point to the cloud because was a theme that was quite bullish. A lot of people, and in their minds, people will think, okay, so you got a recurring revenue source, you got high visibility, the SaaS business model allows for stability. They should be able to give you an outlook for the end of the year. But actually, many of these companies say, oh, things are actually quite unstable out there, and the customers kind of what they're calling deferring their contracts. They kind of just pushing it out a little bit. We haven't lost it, it's just gone out a little bit. Now, phrase it however you want, but at the end of the day, it's that mismatch between what the company is going to do over the next 2, 3, 4 quarters out over the next year, and investor expectation. So by knowing the market, I'm talking about you as an investor not knowing every single thing about your one company, okay? Because ultimately, a lot of people get really passionate and they drop all the product names like, oh, the company is doing X, Y, Z, and the company's got this lined up, and they sign the contract, and that's just gobbledygook, okay? That's just like, it's not going to help you as an investor, because you can know all those names or those product companies, but if you don't understand that the landscape is going for a bit of a turmoil, you as an investor are going to struggle. So the good way to go about it is try to have different buckets of your investments. I do that in my own marketplace, and I think that's quite helpful. Have one market, one idea in a certain sector, another idea in a certain sector. So by being very selective and say, okay, this is the best in that sector, this is the best in that sector, thinking like that, I think really puts the odds in your favor. So when it comes to knowing the market, it's very different, because you can just follow like 2 or 3 companies within each sector. It's not a lot of work. You can do that, and you can just follow those 2 or 3 companies and kind of get a vibe. And many people feel that they have to really dig down but I believe the contrary. The more you dig down into those numbers, the more you're looking for confirmatory evidence. You're looking for evidence that agrees with you. This is something that I picked up from Charlie Munger. And if you look at, let's say, Darwin, he's looking for an alternative hypothesis. So he's looking for something that misaligns with his original hypothesis to prove the rule. This is, in sciences, they use H0, which is the alternative hypothesis. So he's looking for something that goes against his hypothesis to confirm his original thinking. So in investing, it's the same. You got to look for several different ideas within each sector, and that can be done, but while being humble enough to know that the future of that sector is unpredictable. Right now it could look quite bullish, but you don't know how things are going to turn out in the next 2, 3 quarters or even a year. So you got to be very careful to not overpay for something that you believe is certain. And that's what I see right now with a lot of investors. A lot of investors are kind of bidding up prices because they believe that the business model is quite strong, but actually it's turning out slowly to be the case that the business model is not as resilient as many people were thinking it was. So you can see a lot of companies right now are really kind of like struggling a little bit. The next thing I want to talk about is dollar cost averaging. So when it comes to dollar cost averaging, I believe having a very strict rule. Don't invest into the company without leaving a 90-day gap. Because when you're an owner of a business, once you bought the first share of the business, you start to think like a business owner. And by leaving time, you as an investor getting to know that company. You don't really know, if you buy a new property, You don't really know the neighborhood, you don't really know the streets. You might live around the corner for a while, but you don't really know that new home until you've been in it. And the same with being a business owner. You can kind of follow the company, but until you've owned that one share and think like a business owner, you're in the driving seat, thinking like a business owner, it's not going to be very helpful for you. Once you bought our first share, leave a predefined time gap so that if the share price goes up or down, you're not being driven to an impulse to act. And I think that's quite important because it's letting time run your idea rather than letting the market or the crowd sentiment, I'm missing out and I think that it's going to go to another 50% over the next 3 or 4 quarters. And that's speculating. And ultimately, speculating is a zero-sum game because you might have a couple of lucky shots and then you're going to have a couple of underperformers. And our minds, we're kind of very good. Investor psychology is very good at removing the times it didn't work out. That's always point to my portfolio. I say, okay, this is like I always put it on Seeking Alpha and I refresh my portfolio and I put, okay, this is really how it's looking. I do that for myself to say, okay, no matter what we've been through, that's how it's looking right now. So I think that's kind of the benchmark to always go against. So I think that it's very important to have these rules. Dollar cost averaging, I think, is helpful when if you start by writing down 2 or 3 ideas before you make the investment. The work goes in before you make the investment. Write down 2 or 3 ideas why stock X, Y, and Z could work out quite favorably. And within that idea, I think it's quite beneficial for you as a shareholder of that business to think about the earnings power of the business. Is this business, is its earnings power is going to be stronger over the next 3, 4, 5 years? Because if it is going to be stronger, people are going to pay a better premium for it. But if it's not going to be strong, if the business is just ticking along, it's kind of difficult. And businesses with not a lot of growth, they're kind of going to struggle. So I think that by being a business owner and dollar cost averaging as the business progresses over time and the earning power looks to be increasing over time, I think that's quite favorable. So just to summarize here, so we talked about 3 different avenues. We talked about having the right benchmark, the 2 out of 3 times you as the greatest analyst in the world are going to be wrong, about knowing the market, knowing different sectors, and about dollar cost averaging. Hope you found this video useful. Don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. You can see the stocks, you can see people's reviews, you can see if that's for you. And as always, don't forget to subscribe and I'll see you soon.